Larry Shover is with us. The CIO at Efficient Advisors is down at the CME. So, Larry, you and I have been talking bonds for a while. There continues to be a fair amount of readiness to sell these things when there's decent news in this market, and they sell them pretty hard.
Yeah, today traders say another day, another deal. If you remember last week, I was talking about how the market just appeared to be so overbought. And I'm talking about the Treasury market. And it didn't take a genius to have we've had a 25 basis point knee-jerk reaction since last week. When you consider the fact that ISM and the lingering effects of that, we had the core CPI with a disappointment. Right now, the knee-jerk's all about Brexit, trade deal in China getting done, or at least something going progressing in the right direction. Has a little to do with fundamentals at this point.
Larry, what's so interesting is when you look at this bond market, I mean, hey, as I always like to caveat, the famous last words of this past decade have been, that's the top for bonds. But when you think about if this trade does turn around, how do you as a trader go about figuring, where the next part of, the next resistance level is? I mean, it looks like maybe we're trying to break through one right now on the 10-year future, but how do you know just how much it got overextended? I mean, it's impossible. It was such a high conviction trade.
Yeah, it definitely is hard to trade. And I think right now you have to use the old adage that good news fades, bad news lingers. And so if we get good news, we're going to have a pop in yields. And I still think it's worth 20 to 25 basis points from here. But that means if we really get something credible done, however, I would fade it, because beyond that, the facts are the facts. Domestic global data, especially in the manufacturing side, sentiment isn't very good. 2% would be that psychological top in my mind. I mean, there's a lot of small numbers to look at between where we are now and 2%, but it definitely could happen if we get a credible deal in place.
This is really important, I think, to come back to the adage about the good news fading, because we look at these moves and they're sharp, right? Even in September, before our data got worse, sharp sell-off that brought us up to 1.9%, and then bam, it went right back down almost all the way before the last couple of days. So Larry, as a trader, does that just mean you have to be nimble and not try to get greedy on how far you go out of the money or how long you stick around in a winning trade for bonds?
Yeah, no, I think you have to be nimble at this point, because even though we could get a bump in yields if something good happens, I think it fades. I mean, I think good news does fade right here, given the focus will go back to domestic as opposed to the news headlines that we keep reading, and we definitely could see a drift lower in yields if something does solidify. But I would probably trade a lot smaller than normal and keep my stops a lot tighter than normal if I was, take a bet on yields in the short term.
We've got TLT down 1.3%, GLD down 0.8%. The two have been moving very closely together, Larry. If you want to try and put on this type of trade, I'm curious where you view opportunity either along the duration, spectrum for bonds, parts of the curve that you think are more exposed than others, or do you just say, look, it trades like gold, and I'd rather, kind of bet against the speculative nature of gold? I mean, how do you sort of go about putting on such a view?
Yeah, well, so my perspective on gold all year has been really the bump we saw in the gold price really was the market realizing that it was a very cheap hedge, as compared to government bonds. And so when bonds, when that relationship starts to shift, then I think gold is going to be latent in going down. And so I think if we continue to see yields go higher, I think I would get short gold, because that hedge mechanism that everybody's looking at. If we see that psychologically important 2% in 10-year treasuries, people are going to be flooding back into that even more so than they have today. Keep in mind that $15 billion year to date of retail money has flown into 10-year treasuries, and it's something like $80 billion into mortgage-backed securities and municipal bonds.
Larry, last point before we let you go, is there a potential for any Fed surprise to disrupt this? Because if Brexit now becomes less of an issue, if there is trade peace, should we start to think about what that means for October odds of the cut?
Yeah, I think so. I mean, there's definitely a chance. I mean, good grief. I mean, this thing can unravel in a heartbeat. We've seen it happen so many times. And I think right now the markets are saying that the Fed was dramatic and preemptive enough to keep the market where it is today. We see the Dow crossing 27,000. I mean, it's a wonderful thing. But yeah, that could change in a heartbeat. But I think a lot of people are putting a lot of faith in the fact that the Fed did do something dramatic enough and preemptive enough for the time being to continue this risk-on rally.
Yeah. All right, Larry Shover, nice work. As always, pleasure talking some bonds with you. It's going to be fun to keep following. Larry's the CIO at Efficient Advisors. Thanks, Larry.